Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. Guys, the Fed has like 3,000 PhDs and there's just me and Bob over here. And we could tell you with one chart that we cooked up what was going to happen. So let's dive in.
Trade Genius.
All right, Bob, we don't have PhDs, but we've been around the block. And even the Fed kind of gave us what they were trying to do. And it's just funny because, we have this chart we worked on and we've shown it before. And lo and behold, right? But they're taking such a simplistic approach to everything that it might actually blow them back up backwards and undo like everything they tried to accomplish with the inflation rate since 2022.
Yeah, I don't get it. Look, I mean, the Fed actually has been pretty transparent here. That's why, we were kind of laughing before we put this on, because I found a chart yesterday. Wall Street Journal acts like they just discovered some revelation. And we're sitting there going, Phil goes, hey, we put this chart up 6 months ago, you remember? And I'm like, yep, sure did. And so anyway, we marked this thing up here is that the Fed will stop raising rates when they get the ratio between the core PCE and the unemployment rate where one is below the other, and then they pause. And that happened, three months ago? And now...
Yep.
Now they're talking in panic mode about cutting rates in March. And so before I show the other chart, Phil, we know March is a really, really important date for a whole other reason. They're going to put a whole bunch of flowers and public relations around this. But at the end of the day, this is when the banks run out of their slush fund. Janet Yellen will have it spent. And they only have one choice at that point, is that they're going to have to cut rates and make the bond market on the higher end look very appealing to investors so they could drive a lot of money out of this equity market into the bond market.
Right.
And I want to show this other chart here. This is like what it looks more formally. And, we're really just going to title this thing, hey, don't get the champagne cork out just yet, because they're talking about, where we are in terms of when the core CPI and the unemployment rate, when they cross each other, then they can lower rates. But both numbers are a joke because they can manipulate core CPI and they can manipulate unemployment. So I would think, for you guys that are listening, is that they're going to make sure that number is going to justify a rate cut in March because the banks are out of money and they're going to have to get the public markets on board with the bond auctions to make sure this happens, where the Fed's going to have to start doing QE in a big way, and then you're going to have inflation going sky high on them. I personally think, Phil, that they're going to try to work their way through this thing until probably the end of to the election end of the year, before the Fed's going to have to really go hog wild on QE. But I don't see any other way mathematically where the Fed's not going to have to intervene in the bond markets to make sure those auctions actually get fulfilled. But what about you?
One thing I'll say to that is the RRP has been doing the uptake on the bills, right? The T-bills. And what I think might happen, here's a theory, is that the Fed will shift their QT from the balance sheet roll-off because they're going to have to make room now for the RRP that's depleted. They're going to have to go into that role of basically it'd be like a form of QE. So we've been having a form of QE going on, except it's been happening from Yellen versus where the Fed would come in and buy. So the Yellen's been stuffing the RRP. The RRP has been taking it up, and they're happy to do that because they're getting 5% returns. On top of that, they can turn that collateral into leverage in the system. And I think it's just compounded into the end of the year here. I mean, there are inflationary risks involved with this. So the Fed's probably actually hoping for a recession to cool the jets on this whole thing. And, they're like, okay, well, we got away with raising rates and the market, had a massive historic short squeeze. We can start from a higher level now and afford to lose 1,000 points in S&P 500 is not the end of the world. Although that sounds like the end of the world, but historically it wouldn't be. That being said, I think what they're going to do is then roll off the MBS. Now, this is an interesting thing because if they got to stop tapering the balance sheet to take on the T-bills flow, because remember, if there's nobody uptaking the T-bill flow, we are broke. This market and this bond market is going to be in a heap of trouble. So that there's no negotiating that. It's going to happen.
Hey guys, we got Black Friday specials. They're really cool. We have the best pricing for the year. You can get our basic package, our advanced packages, our VIP rooms, software, trade options, trade crypto, trade the futures. With us, get our indicators, best prices of the year. Take advantage of it. Thanks for listening.
So then they don't want to stop the QT because it fights inflation. That still hasn't gone away. So I think they're going to roll off more of the MBS. So what the interesting dynamic on that is that it's going to raise interest rates on mortgages. Everyone's going like, mortgage rates are dropping. They're not comprehending this mechanism that's waiting behind the wings here, and mortgage rates are going to jump back up. So if you think rates are coming back down, you're thinking, oh man, I'm going to be able to afford that house I couldn't afford anymore. It's not going to get there. I doubt it's going to get there. And this is why they think they're going to be able to still fight inflation, bring down these historically high housing costs. And I'm okay with that. I think, it's probably ultimately healthy, but you guys have to keep in mind that mechanism is probably how they're going to navigate around the RRP going to zero. So it's going to be interesting how it affects the net liquidity flows. We won't change how we model that. And you guys can obviously get that package to monitor the net liquidity flows, but it works. I mean, look, we had risk on a couple, 3 weeks ago, and it's just been straight up in the air. So that's been a really good risk on trade to take. And so I don't think that's going away, but how the RP going to zero and them adjusting, and then ultimately this balance sheet reduction that we've been seeing for 3 weeks on, 1 week off, 3 weeks on, that's probably going to be adjusted somehow. So that's where having that net liquidity model is going to help us, because then we don't have to guess. We'll just see how it's affecting net liquidity. And ultimately that's going to affect the way these markets move.
Yeah, people don't understand the mortgage market. They think a 30-year mortgage, you tie it to a 30-year bond, but mortgages turn over every 7 years. And so they really model it down so they can keep interest rates not from being too crazy. But we're in a situation now where the refi boom is gone, the purchases are gone, and they're going to have to push that yield curve out. And that makes also the rates go higher too. So there's a lot of dynamics that just aren't obvious right from the get-go. But for sure, look, and I think I'll save this for tomorrow, Phil. Let's talk tomorrow for the weekend, what we think really the next probably 12 weeks look like, but we'll focus on these next 6, because I think that's when the big pivot is. So stay tuned to that, because we're starting to get visibility as to what that looks like from a macro standpoint, and it's going to be really interesting times. If you're a trader, these next 3 months are going to probably be the most favorite time we've had probably in months to trade a two-way market. So it's going to be really interesting. And final thing I'll say about today is that we are getting the pivot in natural gas. That contract expires on the 26th. Traders have been net short that thing. I don't think they're going to be able to roll enough of their short position out forward without causing a bit of a push higher in natural gas. We've had a move from 115 to 97 in the last 2.5 days on KOLD puts. Okay, so it was a marvelous week for us on that end. And I don't think it's over yet. I think between now and probably April, we'll probably see KOLD, which is leveraged long position on natural gas. By April, we'll probably that'll be down probably in the 30s or 40s. And I said it wrong. It's the leveraged short position on natural gas for trading. So as natural gas goes higher, that's the inverse. So I'll say it 7 times, I'll get it right sooner or later. But that trade is so lopsided that I think if it just moves back to $3 for natural gas, which is not a big move at all, you're looking at those leverage ETF, that inverse will go from, where does it now at 100? It'll be in the low 40s, if not the 30s by April, which is the seasonal high period for nat gas. So the timing is pretty good to get yourself into that. And maybe tomorrow I'll give you some trades that you could take that we're going to position ourselves for going into next year. With that, Phil, I know you're a little under the weather. I'll lead us out. Hit like, subscribe, notification bell. Check us out. Check out our service. We've got a lot of pats on the back this week. I think we called the micro here pretty well, and hopefully made people a lot of money. And if you guys want to trade with us, come check us out. TradeGenius.co, TradeLikeAGenius.com. Have a great day. We'll be with you guys tomorrow.
Trade Genius.